Hello and welcome back to another episode of Under the Hood, brought to you by Accountants Daily. I am your host, Imogen.Wilson, and I hope you're all gearing up for the federal election coming very soon on May 3rd. We have been absolutely inundated with election and political party news the past few weeks, as well as some American politics with Trump's tariff announcements, what that will mean for Australia and its businesses if you've been following along with us on Accounting Times. But today on Under the Hood, I am very excited to be jumping into the juicy topic of tax depreciation with BMT Tax Depreciation CEO Brad Beer. Welcome to Under the Hood, Brad. How are you?
I'm fantastic, Imogen. Great to be here talking tax depreciation, of course.
We absolutely love it, and it's so nice to have you in studio this morning as well. How has the start of your year been?
Yeah, pretty good start to the year. I did some skiing. That was good.
Lovely.
But overall, the people have been ordering depreciation schedules. We're getting them done. And those are the important things, I suppose, from a work perspective that we want to make happen. Been a bit heavy in commercial this slow January, but then really, I don't know, everyone decided in February, the one they didn't order in January, they wanted to order in February.
Everyone go.
So it has been a bit of an odd year in respect to a really big day and then a small day and you don't know why.
Oh, absolutely. And we're recording this in April, but by the time this comes out, it will be May because April doesn't really exist, does it?
No, it's pretty much gone.
It's gone. It's gone. 10 days of bliss in the middle there, which we all love. So for everyone tuning into this episode today, Brad and I will be diving headfirst into the depreciation space, giving you all the inside information you need to know when it comes to understanding it and using it to your advantage. But before we do that, let's start how I always love to start, and a little bit of a personal introduction. How did you get to where you are today, Brad?
Oh, nearly 28 years ago. I started some work experience at BMT Tax Depreciation, probably not knowing what a depreciation schedule was, doing a construction management or a building degree as you come out as a quantity surveyor. This many years later, I'm the CEO and have run this business for some time and the majority shareholder of it with a couple of hundred people, and we've done nearly 1 million depreciation schedules. So I had to learn what they were and how to do them and how to do them well. And I've had a great journey from then to now in I guess learning how to do those and produce a good product and continue to try to innovate and also to drive and grow a business from a spare room that it was then under the original guys that started the business. I was the first employee, so we've had it's been a really interesting time and been lots of learning, and I've really enjoyed it.
Amazing. And so obviously it's quite a niche little area that you're in. How do you find yourself in that to begin with? And what do you like about it? I love asking people that because we all end up in weird things, don't we? And we end up, finding things that we enjoy.
So, I fell into it as work experience.
Yeah.
And obviously I liked it because I'm still here. But if I thought about the good things, I've really enjoyed being early stages in a business and watching us go and get really good at what we do, push, market, get involved, educate around the country to be by far the market leader in numbers of depreciation schedules over that time. But I look at the time I spend, and I spend a lot of it with property investors and accountants and people in the property industry. We help them save some tax. So many people that we deal with have bought investment properties, and lots of investors only buy one property. We know the stats of whatever, 75, 80, depending on which ones you look at, 80-odd%. And they don't often, or especially back then, know exactly what they're doing, especially around depreciation. And we've had the opportunity to teach them over that time to really teach the property industry what it's about, what does it mean for the numbers. And I've seen lots of people get lots of money back after they've done it and amended a couple of years and didn't realise it was there, and they're happy.
Well, that's what you want, isn't it? A couple more dollars in your pocket.
It's one good thing about the service that we do is if we don't do it unless they're going to get some money from it. So I don't really have people unhappy unless we muck something up, which we just got to fix it.
Yeah,
and,
absolutely.
We don't do it unless they get some money. So I've listened to the journey of property investors over all that time, and become one and passionate about it myself. Love it. Bought, renovate, develop, all that sort of stuff. I've really enjoyed doing, and I've made some equity out of those things, starting from nothing in that, and so that's been exciting as well.
Yeah,
and I get to talk to other people and learn about how they do it, try to get better at it.
Oh, too good, too good. So for everyone tuning in, obviously our accountants out there will know what depreciation is, but if we're dumbing it down and we're starting from the foundation and we're going from a property investor probably perspective today as well, what is depreciation and why is it important for property investors to know?
Yeah, so the accountants do understand, obviously, where we are. And for those that don't, if they're listening today, it's. I mean, the easiest thing is let's compare it to a car, because everyone understands those. You buy a new one, you drive it out, it's worth less, and then worth less next year, and so on. It depreciates in value. If you use that car for business, then you will be able to claim that loss in value or depreciation over time. And the same kind of thing works with property. The difference is we're trying to buy property that goes up or appreciates in value. The property itself's going up in value, but the carpet's wearing out, the bricks and mortar are wearing out, the stove's wearing out. Those things are depreciating. The tax office allows us to claim a deduction for that loss in value of those things. Why is it important? Because it means lots of money. The average first year claim out of the reports we did last year was about $11,000. So that's the average. So some get more, some get less. That's a fair bit of deduction out of a residential investment. That's a residential average. So it makes a big difference to the cash flow. And people that maybe are struggling to afford that property, if they haven't done this property, well, how about $11,000 tax deduction?
How could you say no?
Exactly.
A little bit of an offbeat question for you now that I'm thinking of it. Who decided in what sense that because things are depreciating, you could claim tax on it?
Well, it's wider than just property. It's anything used for business that's a plant and equipment item or an item. It loses value. So we buy a car, we use it for 5 years to drive around and do our job, then we've lost money by using that car for our business. A property investor's business is renting out a property that's going to that's being used to produce income. It's losing value against those items, and it's the same concept. So it doesn't just apply to property. It's across whatever is used for business purposes. We depreciate them. So who came up with that originally? I don't know.
A genius, obviously. It's all about the dollar bills. So if we're talking about accountants, why don't they look after depreciation?
And look, the key... People often think, the first question, doesn't my accountant actually look after that? Well, the accountant is like your general practitioner around your health. They look after stuff all over your body and see what's right or wrong with it. But if you have a real problem with your ear, you go and see an ear specialist. And that's probably a close analogy because... And the reason we're there is actually around construction costs. We're quantity surveyors. We're not accountants. I did a building degree. We come out of that with the ability to estimate the construction cost of a building. The tax office says we want the depreciation relates to the construction cost and the things that are wearing out because there's a cost to start. They wear out over time. We put that base cost together. And if you don't have all of the actual cost, there's some legislation that says that they'll accept the estimate by a relevant professional, such as a quantity surveyor. Doesn't mean we're the only person to do it, but the reason we do it is that there's that compliance piece that take away that risk of the construction cost. Then on top of that, we go to the house, we have a look at it, we find everything, and we know how to get the maximum deduction out of it. So you've got to marry those two sciences together, the knowledge of construction cost and the knowledge of the tax rules, and produce reports that go to the accountant and do the tax return. Accountants are our friends. People think, well, what about my accountant? And your accountant's our friend. He gets our report, he or she gets our report, uses it, and gets you more money back in the tax, and they think he's awesome.
Oh, yeah, we love that guy. So if we're talking about tax rules and the tax office, everyone's favourite little topic there. Do you have much to do with the ATO on your end, or it's kind of you're the accountant is the middleman for you guys?
The accountant is the middleman unless there's questions about a report.
Right.
The ATO's department will ring us up and ask questions about the reports. We answer them. We back them. After nearly 1 million of them, I don't think we've even had to change any, or a couple of we may have messed up, but that's a lot of schedules. They know, they see our reports. I've heard people say it's a BMT report. It's been given the tick from the department, kind of. We had a question here. That's unusual. Because
What's going on?
We've done so many of them. The department will contact us now and then, and we answer the questions because we've got more information. We've been to the house. We've had a look. We've got photos than they do, and we know the rules. We know what we've done. We make sure we stick by them. And they ask questions that are usually pretty easy to answer.
Yeah, for sure. And I mean, the accountant might get that question and go, "Oh, I don't know, Brad."
Yeah, and they do that as well. So
Yeah.
sometimes straight to us, sometimes the other way.
Nice. So we've had the terms quantity surveyor thrown around and a depreciation schedule. What is a quantity surveyor and what is a depreciation schedule? Why should you use one?
Yeah, so quantity surveyor, traditionally what a quantity surveyor does is they get a set of plans, they measure everything up. Before that was digital, that we had a set of coloured pencils so we could colour it as we did it after 4 years of uni. So we can count the bricks, we can measure up the concrete, the steel, the carpet, everything in a building. How much would it cost to put it there? So we might work for builders, banks, developers, anyone who wants to build something. We could count the bricks and tell you how many to buy and how much it would cost to get them there and actually build it. A depreciation schedule is basically a list of the things that you can claim the depreciation or the building allowances, two parts of it that's put together by the quantity surveyor. This is all the stuff, I guess, the building, the cost of it, the value of all the items in there, and this is what you can claim against those. Basically, it just sets it out, tells you how much to claim each year from when you buy it to when it all runs out 40 years later.
Is this something that everyone's doing, or is there some people that don't really know that this is a thing?
There is many more that know it's a thing now,
Yeah.
which is great. I feel like we've got some success there after 27, nearly 28 years of talking about it. We still find there's probably 70% of people are not maximising it properly because they didn't want to pay $700 and get something on top of the accountant's fees. They have been given something by someone that's got some cost attached to it that's not really done as well as it could be done, or they just don't know. They think someone tells them it's old and you can't get it, but you can. It's not as much, but so for whatever reason, that's one good thing we go and do and talk to people about depreciation. They go, "Oh, I've had this property for 2 years. Go back and get some money." They're usually happy. And why didn't we do this before? But they're much better now than they were back in the early days when people stared at me blankly when I said I'm a quantity surveyor that does depreciation schedules.
Everyone's
A
like,
lot more people
"What?
actually sort of go,
Who are you?"
like, what on earth is that? They think you're a cadastral surveyor, one of those guys measuring on the street with the
Oh,
theodolites.
absolutely. No,
Yeah.
I'm going to put money in your pocket. And they're like, "This is a scam."
Yeah, well, that's the other thing. How long has this been going on, Brad? I get that question sometimes.
Oh, that's too funny. So we're just going to jump to a quick ad break. Welcome back to Under the Hood. Today we're talking about tax depreciation with Brad Beer. So Brad, if we're talking about major differences in depreciation with old properties and new properties, what does that look like?
So the first thing is that a new property costs more to build, and the claims relate to construction cost and value of some items. So you get more out of new properties because they cost, this house now costs more than it cost, especially lately. Construction costs have gone up substantially. So they cost more, so you get more deductions. The things are new, so they're not used. Nothing's used. It's all new. It costs more deductions. There's a second thing that relates to a legislation change in 2017, which seems like yesterday, but it's actually quite a few years ago now.
It is a while ago now.
If you buy a second-hand residential property, you can no longer claim on what's called the plant and equipment, which is like the fixtures and fittings, the things that don't last as long and have a shorter life than the bricks, I suppose. Carpets, hot water services, stoves, blinds, curtains, that sort of stuff. There's a list of them. In a new property, we put a value on those things. You get to claim for them over 10 years, 12 years, they're different ages. In that legislation, they decided second-hand plant items, they suddenly have a zero value for the purpose of depreciation, and you don't get to claim them anymore. So the difference between new and old is, firstly, new gets the most. Secondly, you don't get that stuff. So there used to be a new property gets an amount, a second-hand property gets a bit less than that. Now it gets a fair bit less, and so it has made a difference to the amount you get to claim out of a second-hand property. The other thing around second-hand property, if it's really old, if it's built pre-1987 as a residential property, you don't get to claim on the structural bit, the bricks and mortar part. So there's less deductions or potentially no deductions out of really old properties that have had no work to do. However, I always say to someone, old property gets depreciation. It doesn't get as much, and some don't get any. But don't worry about that unless you've asked the quantity surveyor who knows all the rules about what you can and can't do before you decide. Because sometimes people, and one of the reasons people haven't done it is people think, oh, it's old, maybe it's not worth it. It's old, it might be worth it. Ask the quantity surveyor. If the quantity surveyor says it's not worth it, then you should believe that, probably. They know what they're doing. If your mate at the pub thinks it's old, then they may not know all of the rules and know that some old stuff does get some deductions. Renovations sometimes get deductions done by previous owners. We go in and find what we can and go, yes, there's things we can find, or no, there's not. And then we'll tell you it's not worth it if it's not worth it.
So if I'm a property investor, would you say it'd be better for me to look for a newer property than an older property?
If you're a property investor, and I'm the depreciation guy, right, there's a whole bunch of reasons fundamentally that you buy an investment property that's looking about capital growth, the reasons you buy in that area, the cash flow related to that property for whatever reason, for all the fundamentals that you buy investment properties. Depreciation is one of those things. I don't make decisions. I don't have all new properties. I've got old ones. I've got ones I've built which are new. But I don't. Depreciation is not your main reason. Depreciation is a bonus that comes as one of the things that helps the cash flow substantially, but you shouldn't make the decisions based on just the tax outcome. It's the whole outcome of making wealth out of investment property. Cash flow is one of those. Depreciation, very important part of one of those. Think about the whole lot of the fundamentals, not just the tax outcomes, is what I believe.
For sure. I mean, it is something that people need to consider, and then they might get a little bit carried away. I mean, I would as well. I'd be like, well, if I can claim tax on this, maybe that's what I'd be thinking about. But what if I bought a property and then I renovated it? Does that then change the depreciation I can claim as well?
Yes, in two ways, especially, you spend more money, put more things in there. So the plant and equipment that you put in there that we talked about is new, so you get to claim for those things. Any other works that you've done that are appropriate, you get to claim some deductions against. But one of the important things, so that's sort of easy because you spend some money, you get more deductions. One of the really important things to consider is before you actually rip it apart, are you ripping out things that still had value for the purpose of depreciation or not? So call the quantity, either make sure there's a depreciation schedule in place or call a quantity surveyor before you rip it apart. Because if you throw away things in there that still have some value left, and it might even be a kitchen. If the kitchen's 30 years old, it's possible you throw it away now and put a new one in. The kitchen's seen as part of the building, 40-year life, it's still got 10 years of its life left and you throw it away. So whatever value is left on that from a depreciation or capital claims point of view is potentially a claim straight away in that year. We call it scrapping. It's not the technical term. It's just easy to understand. And we made it and called it scrapping because you're scrapping stuff, you're throwing it away. It might have value left. Don't throw it away and not get it. Make sure you've got the depreciation schedule in place up front so you get both of those things.
So if everyone tuning in, moral of the story is engage a quantity surveyor.
Or at least talk to them.
Talk
to them and see if there's money there. They won't. You engage them if there's money there, and any good quantity surveyor should know that before they go and do all the work by having a look at what you can see.
Mm-hmm. For sure. Okay, so and then if we're talking about residential versus commercial, what's going on there?
So the whole same concept applies, and commercial. I mean, the average deduction I think was 52,000 in the first year for the commercial properties we did. Lots of them, everything from a pub. My name is Beer, and we like those. To the Melbourne Eye, to a hotel, to an office building, to lots of little industrial sheds, all that sort of stuff, basically. The one, I guess, key difference, there's a few minor differences that are changed. There's a slightly different date on the construction piece, not much different, but it does, some apply, some get the deductions and some don't. But the legislation change around that plant and equipment that's secondhand doesn't apply to non-residential property. So if you buy a commercial property that's 2 years old, you still get to claim for that 2-year-old carpet because it still has some life left, which is the right way to do it, by the way, because if you buy 2-year-old carpet, it's still worth something, has some value, and you should get what's left in depreciation against that. So you do get that on the commercial property. So second-hand is not as far away in deductions from the new and in commercial properties. But yeah, commercial properties done many of those over the time as well.
Yeah, okay, interesting. There's so much to think about with it as well, like so many different considerations that you probably wouldn't even think about, really.
And the important thing is when you buy property, whatever it is, you use it for investment, you've got to think about all those things, including just the depreciation. You'll ask the questions. It's pretty easy.
Just ask the right questions. So is there any common errors or misconceptions within this area, either from like your end or people that you're training up or people like property investors, accountants?
The most common, the most common two, I think we've hit, and that is, doesn't my accountant look after that? That's the misconception.
Yeah.
I've got a good accountant. What's wrong with my accountant? Your accountant's probably great. If your accountant's good, they should get the ear specialist or the specialist for the areas that they need them to get the most out of it, basically. The second one is really just around older properties. People think, it's 10 years old, it's 20 years old, I won't get something. Get that out of your brain. Age doesn't matter. Age doesn't matter. It does make a difference, but you should always ask the question of someone who knows all the rules to see if there's money there for you. I don't know. That seems to make a lot of sense to me, and that is the reality with this. I think probably the later misconception, if you want to call it that, that we've seen, especially since COVID, is in our industry. We've been a purporter of site inspecting the property because we find everything, we can estimate the construction cost better than just do it off a few photos that we can see online. And that's a major thing that happened through COVID in our industry. We held on to our jobs when we couldn't get in there, and we said we're going to do it. We're going to maximise the deduction by finding everything by getting to that site and having a look at that house. And if the tax office asks me questions about something you've already ripped out and scrapped, I got photos. My photos. I've been there. I've assessed it that way. Lots of our industry has gone down a different path of we can just do something off the photos. In my opinion, it's not as thorough and it doesn't get the best result, and I've got more data than anybody on it. And we assessed it. We looked at it 2/3 of the time, even if you had some original costs. 66% of the time out of 100,000 properties we assessed over COVID, there was some sort of renovation that someone had done after it was built. So if you used the original cost, you wouldn't have found it. You may have found it off the photos, you may not have. We still think, and as you know, look, we still believe, based on the numbers, that it's the best way to get the right, it's the way to get the best result and the most thorough result. Thorough result will usually mean more deductions, and that's what we're there for.
It's back to the dollar bills, isn't it?
I have 200 odd staff, and we've got to go to these houses. We're going to ring tenants and say, can we come in, take a photo throughout your house and measure it up and do all that? It's not the funnest part of the job, but it's what we do to get the best result.
Absolutely.
They don't like you there. They don't want you taking photos of their stuff.
Tenants can be a little bit odd, can't they?
I think for us it's a little harder because maybe it's a little harder. We look at some of the things like a smoke alarm. Tenants, someone wants to come and check my smoke alarm. I go, no worries. I don't want my house to burn down as a tenant. You want to come and do something for the owner's tax?
100%.
Yeah, I don't care about that.
No, this is actually really important as well.
It's really important for the owner, but
For
not
the
for
owner,
the tenant.
not for you. Sorry, coming in. That's too funny. So if we're talking about the business side in COVID, which is 5 years ago, crazy stuff, how was that from you running a business through that time? Because we also cover businesses here at AccountantsDaily and Accounting Times. People love that stuff. How are you running your business? How was it through that time? How has it changed?
It was tough. It was tough for anyone that runs a business, largely due to just uncertainty. We just had, lots of people have different added difficulties around it. The one difficulty we had is that we go to people's houses. They lock us down. Even when they open up, through some of it, WA's I've got guys sitting around, and everywhere else I've got jobs coming out my ears. They can't move them from state to state, which we do across the board a fair bit at the moment. The uncertainty of when are we going to be able to go and do these jobs and get in and make them get the best results for the clients. And also the added challenges. A lot of our industry went, we'll just do it off the photos. So we're going, well, that's not really the best result in our opinion. So we explained to the client, when it opens up, we'll get there. I think I had 6,000 jobs to inspect when they did open up after the last lockdown. So everyone the next week goes, oh, you can come and do it now. Great.
Like,
You with
great.
6,000 others.
I'll be working 24 hours a day.
well, we've had some of our people have, so we had a few less staff. Some people left and whatever. So then you had to ramp up and try to do it. It took us a long time to catch up. It was very difficult to run with the uncertainty more than anything. Like if your business is struggling to get numbers in the door, you've got to go, okay, well, what do we need to change? They're locking down and then locking down again. You don't have control over anything to change other than working with what you've got that you have no control of. And that was probably one of the most difficult things. I get a message every afternoon about the number of jobs that have come into our business for the day. And if that starts downward trending, I've got to go, well, we need to do something. Well, I mean, we've got to do something. What else do we need to do about that in the way that we're doing and running our business? And we need to do that all the time. I've got some, but no one else is, other than economic issues or investors. I mean, we focus when we put together our targets for the business based on the number of transactions that loans that have gone to investors, and people don't buy it off us straight away. They buy it off us when they're doing sort of the next tax return a year or so later. So I've got a good indication of how many, opportunities in the business that are there for people that have bought investment properties before. Like if there's no one buys anything, I know in a year I'm probably going to have a problem, and I've got to act accordingly. If people are buying lots of stuff, there's more opportunity for our business, and we just got to make sure that we take our good sized market share of that up or down over the time based on what happens. But yeah, very challenging time, and largely because of the uncertainty. I'd have to say though, that if I looked at challenging times in business, and I've been in this one for a while, the legislation change back in 2017 was probably actually a bigger challenge for us because it actually changed what we did and what we could claim on, or people could claim on. And also it was at the same time they got rid of the travel allowances, right? So I was actually at the budget night, and but travel allowances.
You were at the budget night.
I was at the budget night that time.
What a night!
On the table, choking on my steak as ScoMo explained this. Well,
What do you mean?
Well, it was everyone's listening to the travel allowances. You can't go and visit your property in Queensland to see it now. You can't claim that as a deduction, and it's probably rorted anyway, and they're trying to get rid of that. And also, we're going to change this depreciation, blah, blah, blah. And everybody else is worried about that. I'm choking on my steak over the over the thing that no one even gave any airtime. And it just sort of brushed through that, and it was almost like, am I the only one that heard that?
Okay, hold up, wind it back.
And then my phone started lighting up.
And everyone's freaking out in the tax depreciation space.
Yeah, basically. So that was probably actually even a bigger challenge because it changed what we did. But the biggest challenge was they said, we're getting rid of depreciation on second-hand plant and equipment. People heard we're getting rid of depreciation on second-hand property, or that's what they thought. So people thought it was no longer there. It's changed. There's a bit less. So I had to take a massive backward step in education of the whole people again to say, it used to be like, get a depreciation schedule, BMT can help you out, you should get some money. It kind of went to when people called, they were like, my accountant said, just to check if it's worth it. Right before they called and said, I need one of these things,
Were you dreading that call?
Oh, no, it just means it's harder to like lots of people. The accountant was not as certain that it was something that would work, so we had to explain to everybody that it still does work. Your property still is okay, although some of them are not. And a lot of our referrals come out of the real estate industry as well. So real estate didn't understand it very well. We'd got them very good at going depreciation. You should get money. Talk to the guys. Now they heard that. It was a re-education process basically, and it was a couple of times in business that were really interesting. I had to learn how to run a business that didn't grow like it did before that.
Yeah.
But all good learning curves. Some of them I don't need back. Full of learning curves.
Love it.
It doesn't kill you, makes you stronger, right?
Oh, absolutely. That's what they say.
Yeah.
So at the moment, obviously, we've got a federal election coming up. There's a bit of uncertainty, lots of business talk. Well, actually, not a lot of business talk going on. Also, not a lot of tax going on. It's a bit of a time. Is that something that you take into account with your business and what you guys do?
It does. Just for some reason that I kind of understand, when there's an election, people are slower to writing depreciation schedules. Even if there's nothing about property in it, there's nothing really. in any of the policies on either side that affect us in really much way at all.
No.
But people still sit on their hands. Now, the funny thing is, people sitting on their hands not already depreciation schedule. We can see a dip in the numbers every time there's an election. The people that we're dealing with mostly have bought the property last year. It makes no difference to them.
Well, everyone just suddenly freaks out and goes, stop what we're doing.
Stop what we're doing.
We need to watch every moment that's going on here.
Yes, it does. It happens like that. But there's nothing we need to change at the moment or do at the moment because there's nothing sort of on the table that really affects the investors. So, I mean, really, the investors have been beaten around a little bit over the last little while with lots of things, Victorian land tax, for example, and they're selling up a lot of, and we've got a rental crisis, but we're beating the investors around, and so they're selling because they go, it's too hard. That doesn't help a rental crisis. So I think trying to change anything at the moment, it's a bit risky, hence it's not on the table from either side, I guess. We need more supply. We need supply. We need to build stuff, which they're trying to do, and there's lots of policy out there trying to do it. But construction costs are high. The things don't stack. There's lots of issues around trying to make that happen. But getting rid of the ones that are there is not the answer.
No, absolutely.
Provide more stock, and then the market, the rental market, if it's got more there, the rents don't increase as much, right? But anyway, there's lots of other things to talk about.
So many different factors. But to wrap us up today, Brad, for all our listeners tuning in, if they wanted to access some tools available, what is available to them to use?
Look, the biggest things are education, and there is so much stuff on. For accountants, there's the packs of information that they can get out to their clients. The easy discussion for them is to go, here's something, this is what it's about, you'll get some money out of it, or they don't do it. So the information that's there via, the things we've done on YouTube or whatever else you do them on these days, videos that we've got that can help the clients that don't understand what it is, understand what it is, so they don't sit there and go, I don't know, do I have to spend $600, $700, $800 more dollars? And that's probably the biggest key. I think things for accountants around the portal that we've built that's got all of their clients' stuff in there, and it's got some cool things for the clients to actually use. All of the reports we've done for one of your clients as an accountant should be able to be accessed there. And also, if the client adds a new stove, they should be able to they can go in and update it for free, and then you get the new numbers for the year, which is that's the thing that, there's 180,000 or something users in that, and they're people that have got a depreciation schedule. They're not looking at it every day because it's not that exciting, but the accountant can go in and see all of their clients' reports. Hopefully some of them have been updated with this year's new numbers with some of the work they've done to it. That's the idea of that, and for lots of accountants love it because I never have to ask you for a copy, Brad. I just log in there and I can see it for the clients. So that's probably a couple of the key things that I guess are most useful.
Love it. Well, thank you so much for coming in today, jumping on Under the Hood and chatting all things tax depreciation.
Thanks, Imogen. Really enjoyed it. Thank you.
If you'd like to contact me, you can reach me at imogen.wilson@momentummedia.com.au. For all my listeners, thank you so much for tuning in. Until next time, chat soon.